Earlier, I spoke to Jan van Eck, the CEO of Van Eck. We talked about China, coronavirus, Bitcoin, gold, and more. Let's listen. Jan, an old adage on Wall Street is don't fight the Fed. So last year, you adopted that for China. You said don't fight the PBOC. Does the coronavirus change that thesis at all for you?
No, in brief, it doesn't. My theory for this year is don't worry, be happy. And the reason is if you oversimplify the world into two countries, the U.S. and China, in both cases, you have stimulative policies from the central bank and the governments. China, the U.S. has been on a streak.
Sure.
China is kind of overcoming a hangover. They tried to crack down on their credit in 2018. And so since then, they took their foot off the brake, but it's still gentle. We call it drip stimulus, but it's solid growth. Okay. And I think they'll recover from this virus.
Gotcha. I do want to get to those, but you mentioned U.S. stocks being near all-time highs. Of course, it's been a heck of a ride. So they're pretty pricey now. Big multiple expansion last year without much earnings growth.
Right.
Where do you see U.S. stocks? What should investors be doing right now? Because they still look like the best house in a mediocre neighborhood.
Well, look, when your central bank is stimulating, you want to own equities, you want to own financial assets. But what we point out is we're not the shop that likes to do just market cap indexes.
Sure.
So what are the distortions or what are the exposures in the market that we like? Well, we're concerned about FANGs, right? The value of Microsoft is greater than the value of all energy stocks combined.
Wow.
So from an outlook perspective, why not own some energy stocks? That's more tactical,
sure,
right? And then in general, if you can get a methodology that buys U.S. equities that aren't overvalued, because now some are getting kind of frothy. We have a wide moat approach. I think that's something to look at, too, if you can embed that into your equity exposure.
And your moat ETF has beaten the market over the past year, and I think over 3 and 5 years. What is the approach that you use to put those stocks together?
I think the main trick, I mean, first of all, we're only dealing with quality companies that have a competitive advantage. But the main, I think, hidden trick is to get them at cheaper valuations. So Morningstar Equity Research looks at the earnings potential, the profit potential, which is the heart of any company, and then says, okay, am I paying too much given our view of earnings? And so what they will do is they will sell stocks on a rotational basis, and that's, I think, an important discipline.
So it's a value approach, but not in the old school way of thinking about value. It's when price and growth just become out of line.
It's valuation,
gotcha,
right, more than value.
Let's talk briefly about the energy patch. You're pretty bullish on that based on just lousy performance?
Well, it's a contrarian view,
sure,
and I also think that if you look at what are investors demanding from a sector that might not have a growth outlook, and that's, I want my money, right? I want my money through dividends, or I want my money through stock buybacks. And energy companies had not been providing that. Only the majors, the integrateds, had been doing that. So investors are saying, I'm sorry, across the board, I don't care how much shale acreage you have have got to show me the money. And so I think that change in mentality in the sector will take a year or two, but that's, I think, that's the catalyst that we need.
There certainly has been a lot more capital discipline in that area.
And sorry to interrupt, but we have a precedent for gold mining companies. So gold mining companies hit bottom, gold hit bottom in 2015. All the gold mining CEOs were fired. They stopped doing their outlandish spending. And then, again, the market didn't believe them for a while, but now it's show me the money, and gold shares are almost making all-time highs.
So that's the miners, but the commodity itself has also done very well. What are the forces pushing gold higher?
It's the era of central banks. We were talking before about central banks as supermen, with capes flying around, solving every problem, including the coronavirus. In that environment with low interest rates, that's great for gold. And I think there's an additional element of a little bit of concern that maybe central banks can't solve every problem, especially in Europe. And I think that dynamic has led a bid to all diversifiers.
Speaking of which, optimists think that cryptocurrency might be the new gold. So you recently dipped your toe in the Bitcoin waters. What's your case there?
Well, it used to be the main way to get this diversified exposure was gold mining companies or shares. Now with gold ETFs, that's a relatively new phenomenon, so that has taken away some of the demand for gold shares. And then absolutely for the younger generation, we are believers that Bitcoin is another sort of component. So it used to be sort of gold and silver, now I call it gold and Bitcoin.
Gotcha. I want to ask you about one more Van Eck product, which is your eSports ETF. Often at Barron's, we warn people away from niche ETFs. We also warn people about AUM. I say under 100 million, it might be a dangerous play.
Right.
Your ETF checks both of those negative boxes, and yet, once again, it has crushed. I think it's doubled the S&P's return. What's your case for an eSports ETF?
Well, fundamentally, a lot of people are consuming virtual sports. More people watch, online sports games than they watch the NFL or the NHL or any kind of established sports. What hasn't happened yet is the monetization of that audience, but the audience is growing, and the way people play the games, watch people who are playing the games, the televising, there's all that dimension. I guess from a 10-year view, it's hard not to think of a world that's more virtual. Now that we all have our smartphones, more stuff is going to happen online. And it might merge with our real lives and entertainment in all kinds of ways that we can't imagine. So that, the long answer, sorry, it's a trend, not just a fad. It's not just a 2-year thing. We see it as a longer-term trend and therefore a tactical allocation. And by the way, it's 98 million or something in assets, so we're getting there.
You're about to cross that threshold.
Yeah.
Jan Van Eck, thank you so much.
Thank you so much.